Well, welcome everybody to Klaas Financial's third quarter update. Let me just begin by saying thank you for participating. I don't know about all of you, but it feels like I live my life on Zoom these days. So we just certainly appreciate you taking time out of your afternoons to spend time with us going through some updates on what's been happening in the economy and in the markets. Let's begin by going through some housekeeping items here. To my right is Todd Eklund. For anybody who participated in our last quarter's call, Todd was a part of that. My name is CJ Klaas, and we come from two different disciplines within the organization. Todd is on the side of being the director of our asset management team or our portfolio management team. I'm the president and CFO of the organization, but also one of the advisors. It's intentional that we actually have somebody from asset management and the advisory team as part of these discussions. As it relates to what you can expect for time, we're going to try to be efficient today because, again, we don't want to drag this out too long. Todd will take majority of the first part of this for about 10 minutes. I'll talk for about 10 minutes, and then we will do questions and answer at the end. Which is a good reminder. You do have the ability at the bottom of your screen, there should be a Q&A section that you can click on and submit a question. If you are coming into this webinar today with a question, I encourage you right now, go to the bottom of your screen and submit your question online. We will be basically building a queue of those questions and then reviewing them at the end of our meeting today. Conversely, if throughout this discussion, one of the slides that we cover piques your interest or pops a question into your mind, please go ahead and submit them.
We'd like this to be an interactive discussion, so please don't be shy with your questions.
Absolutely. This is meant for you, so submit them when it's right for you. And finally, just a quick refresher on who Klaas Financial is. We'll bring up some information here on the screen. So Klaas Financial has been in business since 1976. We currently work with about 1,100 households, and we have 18 employees between two locations, one here in Madison, Wisconsin, and another down in Loves Park, Illinois. We've been in business for 44 years. It's been quite a while. It's been a great ride. My father and his brother actually founded the business right out of college back in 1976. We currently operate in 30 states across the United States, and we have just over $500 million that we oversee for our clients. But the core of what we really do is we help individuals, families, and employers both plan and invest for retirement. A lot of times people ask me that, what do you do? And that is at the heart of what it is that we do and what drives us every day. At this point, I'm going to turn it over to Todd as he walks us through some information about the markets and the economy.
Thanks, CJ. And wanted to say, I know CJ mentioned it earlier, but thanks again for joining us. I recognize that this probably isn't the first Zoom you've been on today or perhaps this week. So we appreciate you making the time late in the day to be here with us for the discussion. Well, to get things started, we want to talk a bit about what's happening in the markets and what a round trip journey this year has been. It's really been an incredible ride. If you think back to March when the S&P 500 went into a deep bear market decline, it was actually the fastest decline that we've ever experienced. It took only 126 days. Now, to come back from that, we also recovered in a remarkably short amount of time. Historically, it takes about 6 years on average for a bear market from a recession for that to be made back up. And we did it in about 3 months this most recent year. So it really has been an extraordinary time. What's been driving a lot of that? You've probably been seeing this in the headlines, but really underneath the hood of the market has been a very powerful rally in technology stocks. And there's a big disparity between the haves and the have-nots in today's business and economy. So the acronym that's been created for them is the FANGs. You can add a fifth one on there. It's Facebook, Amazon, Apple, Netflix, Google, and Microsoft. These 5 stocks have really powered quite literally the entire stock market. And we'll show you on the screen that just the disparity between what these stocks have done and other sectors that are hit harder by the pandemic like leisure travel or malls, retails, things that are dependent on foot traffic, they're still really hurting. So we've had big differences in the winners and losers, and we expect that to continue. One of the key things behind what we would call the Fab Five stocks is this idea they actually are flourishing in today's environment, and so it's not as if there isn't a reason why they're doing well. They've grown their revenue substantially in what has otherwise been a low growth and challenging economic environment. But one of the offshoots from that is that the stock market today, the S&P 500, is extremely concentrated, is dominated by these 5 stocks. And we actually have the highest concentration at any time over the past 40 years. So the market itself, these are the engines of what the S&P 500 is going to do. There's good things and bad things about that. Apple, for instance, Apple is bigger than entire countries and markets throughout the world. Its market cap is larger than the entire FTSE 100, which is the largest 100 companies publicly listed in the United Kingdom. So one company in the US is larger than all of the UK's biggest, most pristine companies. We've got some good things here in America with business, and they're doing well. But on the other hand, what that means for investors is that, well, number one, we want to make sure that we stay diversified, that we don't get too excited. We pay attention to what's happening. We spread out. The other thing is that the S&P 500 is not as good a proxy for being diversified as it once was. So we're paying attention to that today, making sure that certainly I would say everybody wants to have a piece of these names, but we also want to make sure that it doesn't become too much of our portfolios. So to switch gears from the stock market to the real economy, I think that's where a lot of us, as the pandemic's going on, there's this big disconnect. We talk about winners and losers, but man, how has the stock market done this in really what is a historically challenging economic environment and recession? And as far as the economic backdrop, things have gotten a little bit better since the eye of the storm. The pandemic in March wiped out what had previously been 113 months in a row of job gains. So we'd been in a really robust, growing economy, and it all came to a crashing halt. And more than 20 million jobs were lost in April during the worst of it. So as you can see here on the screen, the layoffs have moderated, but they're still historically high. Much higher than we've ever seen. And really, the crisis today, it has had an uneven effect. It's hit some areas of the economy a lot worse than others. Looking across just the headlines recently, though, it will be interesting to see how this all unfolds. I think a lot of businesses will be affected by this, and some that aren't expected. You probably read over the past months that a lot of theme parks like Disney laid off their employees. But I was telling CJ earlier that where I began my career, Pacific Life, which is an insurance company in Southern California, laid off 300 employees. And in that same article, I saw that Allstate, which is here in the Midwest, is going to do a reduction of about 8% of their workforce. So insurance companies are facing the challenge of low interest rates and a tough economy. They're financial companies, but they've been impacted by this as well. So we're monitoring this, but it really is, things feel more normal, when you go outside, but it still really is a tough time in this country throughout the whole economy. And as we kind of talked about, the biggest stocks in the stock market are not representative of the whole economy. They're the largest, strongest companies, and it's not representative of the market as a whole. A study put out by the Brookings Institution noted that small businesses, on average, year to date, the revenues are down about 20%, and small businesses employ about half of all workers in the private sector. So, small business might not be in the stock market, but it's a tremendous driver of jobs and paychecks for people in this country. So switching gears, this kind of ties into why have the big public companies done so well? Well, a big part of that is the boost that they're getting from interest rate policy in the Federal Reserve, which has come to the rescue with extraordinarily low interest rates. Since I've been working in the industry over the past decade, we've been in this period of time where the Federal Reserve has taken unprecedented measures to help prop things up. But looking at what we're faced with today, it's unprecedented. And interest rates have never been this low in any of the prior recessions, even with the policies in place. And I think another challenge is that they are this low, and they're probably going to be there for a while. The Federal Reserve has made a change to its policy, how it looks at inflation. And in so many words, they're not going to be in a hurry to try and curb inflation. They'll let interest rates stay low for some time to help prop up the economy. That's been a big boost to these big companies. They can weather the storm, borrow, push things out further into the future. But it also affects us as investors, savers and retirees. Interest rates have never been this low, and for what you can earn on a relatively safe investment in bonds, which bonds are considered stable. In the past, it's an area where if I'm in bonds, it's safe and I shouldn't lose. But what we have to focus on today is, are you going to stay above inflation? And that's really the challenge that with where interest rates are today, you're just treading water with inflation. So there's been a lot of acronyms that have been developed over the past decade to talk about what the Federal Reserve has been doing. Things like QE, you probably read, as quantitative easing, ZIRP, which is zero interest rate policy. But the one that's getting used a lot today, and I think really captures it well, is TINA, T-I-N-A, which is there is no alternative. And I know that sounds flippant, but it really captures it that as investors today, you have to take some risks somewhere in stocks in order to grow your portfolio's value over the course of time. And it's just a reality that we're faced, that if you want to stay on the sidelines, keep it safe, we really are looking at a scenario where your money won't maintain its purchasing power for you in the future. So you always be cautious with that, but there's a lot of truth to it. And I think we've been trying to talk with our clients about that taking risk in those growing pains of taking the risk to grow your portfolio is a necessary thing to be doing in a healthy, disciplined manner. So let's switch gears from the markets and talk about something that's probably on everyone's minds in the weeks ahead, which is the elections. It's been a interesting year in so many ways, and you throw the election into it, it's just a crazy topsy-turvy time. You might have listened to our prior webinar when we were talking about these things, and CJ and I agreed today that we don't find it very useful to come here and opine to you on what we think will or should happen with the election in politics, but we instead wanted to talk about an interesting way that we might take a look at what's being priced in for the election outcome. It's not our opinions, we'll expand on that in a moment, and what it can mean and really what it means for investors, over the longer term. So as I mentioned, we're going to stay away from the Gallup polls and the TV panels, but one of the interesting ways to take a look at elections is what's known as prediction markets. And what I mean by that is a marketplace-based assessment of the outcome of an election and so forth. And so this has been done by the University of Iowa for the past 30 years through the Iowa College of Business. They call it the IEM, Iowa Electronic Markets. So these are real money futures contracts that participants buy and sell based on the outcome of an election or event. And so it's the idea that it's the wisdom of crowds. The price of a contract at any given point in time is an implied probability forecast for the election outcome. So as I mentioned, that they've been doing this for 30 years. Historically, the implied price has been fairly accurate. They're not always right, but they've been pretty accurate in forecasting outcomes for elections. And the other thing that makes it unique is that they adjust quickly to new information. So, when I say it's a marketplace-based appraisal, that might not be something that makes a lot of sense to you, but maybe we look at it through a different context. I don't know how many of you have friends that like to bet on college football or the sports book, for instance. I'm not a gambler myself, full disclosure, but for example, in Las Vegas, the sports book, sets a line each week for college football games, and they'll take into account all the factors out there that they can analyze, right? The team's roster, whether they're playing at home, what's the weather going to be like, the team's injuries, all the pieces of information go into pricing the odds on a given game. And they'll do that a week ahead of time. And then people place their wagers on it. And the prices then adjust based upon how people place their wagers. So if a lot of people are betting on a particular outcome, the prices adjust accordingly. Now with college football, the implied odds of games over time have been pretty good predictors of the actual outcome. And as I said earlier, there's always upsets. We watch them on TV, but overall, they tend to be fairly accurate in picking the winner, across the board. And the idea behind that is market efficiency, right? That the people who go and place bets on college football each week, they're not doing it because they're Badgers fans. Most of them are, knowledgeable, informed, and they've got their skin in the game, right? They're putting their own money into picking the winner. So anyways, in saying all of that, why are we bringing that up is that, well, prediction markets like the Iowa electronic markets have many of those characteristics. So, the participants are putting their own money, skin in the game. They're presumed to be knowledgeable and informed, and they're not doing it. They're not placing the wager presumably because they follow either political party, but because they want to win and they follow what's happening. So it's worth noting that these aren't always accurate. In fact, in 2016, the last election, the prediction markets, the IEM, had been predicting and forecasting a pretty sizable victory for the Democratic candidate Hillary Clinton. We all know what happened. We wound up with President-elect Donald Trump. But for this year, the markets, as of yesterday, are implying a slight edge to Biden, the Democrat, 57% versus 43%. So I think one of the takeaways from this, it's going to be a tightly contested election. We don't know what's going to happen. But as we look past this, it's going to be a crazy time. There's going to be a lot of noise in the weeks ahead. You're going to be hearing about it. We wanted to share that without getting too rambunctious about what we think is going to happen post-election. And I know there's been a lot of talk. All of us will hear it from somewhere in the weeks ahead, whether it's from our friends, our neighbors, relatives, in-laws. There's people out there that think that if the election goes one way, that it's going to spell a big deal for the markets, the economy. And the truth is that over the long run, the stock market is politically agnostic. It tends to, for the long-term investor, be a good investment over the course of time, and tends to go up regardless of whether either political party is in the White House. So, I would encourage everyone to really, in the weeks ahead, stay objective and really try and diagnose the urgency trap to do something, or that you need to take an action. And I'd say that if you do find yourself having a conversation with someone that that is absolutely certain about what's going to happen in the election and eager to move their money around, you can point them to the Iowa College of Business. It's tippy.iowa.edu, and they can open up an IEM account and place those wagers there.
Well, and let me just say, so what you're seeing on your screens right now is showing you the performance of the S&P 500 with different colors representing the Democratic Party in the White House versus the Republican Party in the White House. And you can see that over an extended period of time, this particular graph goes back to 1928 up to 2019, that the markets just kind of do what they do. And people try to find trends in that, but you can see that actually markets on average have gone up, whether there's a Republican or a Democrat in the White House. And truthfully, there's something raw and real about that, because I run a business. Todd's here helping us run this business. There's many people that run businesses, and last time I checked, just because their president or their party's president isn't in the office doesn't mean they're shutting down their shop, right? So the impetus of why the market remains fairly agnostic is because businesses want to turn a profit. They want to buy and sell goods and services, whether they like the policies of a president or not. I do empathize with everybody on with us here today, because when you actually listen to the debates or any of the rhetoric from the media, they will make it sound like if this candidate, then recession. If that candidate, then recession. And so we recognize that you as consumers are not getting this from nowhere. You're getting it from the fear mongering that is going on from both the presidential candidates and their political parties and affiliates. But at the end of the day, if you just take a step back and actually look at what happens in the markets over time, they tend to give us positive rates of return over long periods of time, regardless of who is in the White House.
a win or lose for either party is not universally good or bad, is the truth. And we'll talk a bit at the end of the questions about, yes, there are certain subsectors and winners and losers, but when we look across the economy, the markets as a whole, it's a wash. And so shifting around or thinking that I need to do something because of who's going to win the political election, it just is not a productive way. And there's no evidence over the long run that it's going to help you or be to your benefit. So we would say this, that the data does suggest that in the lead up to elections, the market tends to get more volatile. The swings get a bit bigger, right? Because there's a lot of attention on it, and particularly for a tightly contested election. But again, looking past that lead up and past those swings, which we have to stomach, and if we take a long-term view, it's something that, regardless of who's in the office, is a pretty good investment, and not looking to either political party for its success. So let me shift gears.
And at this point, I'm going to jump back on and talk to you about, at a little bit more of a practical level, why diversified portfolios work. So as you all know, after we've gone through that information, one big thing we do here at Klaas Financial is focus on how we can help you succeed with your portfolio and with your financial plans. Todd is the director of portfolio management team that helps us build and trade and manage the actual infrastructure of what it is that you own inside of your accounts. I then work closely with our advisory team on the both communication and implementation of financial plans with you as clients. So diversification is really about increasing the likelihood of obtaining a targeted or expected rate of return. Let me repeat that. It's about increasing the likelihood of achieving your targeted or expected rate of return. In that, you've heard, even we tell our young children this, don't put all your eggs in one basket. And
or the 5 stocks.
or the 5 stocks. So we are going to show you a couple of slides now that we've given you that definition of why this is such a critical piece to understand. What you are looking at here on the screen is a real world example of how you, as a customer, as a participant in the markets, feel the ups or downs of the market.
How you experience it.
How you experience
when
it.
things get tough.
Often we will hear somebody say the S&P 500 was down 37% in 2008, which is a true statement, by the way. If you took it from January to December, S&P was down about 37%. However, that was not the feeling that most of you had. If you owned the S&P 500, what you were focused on was actually what's called a peak to trough decline, meaning what was the highest value I ever saw in my statement? What was the lowest value I ever saw in my statement? What you are seeing on your screens right now is actually a peak to trough, known as a max drawdown experience of 2 different representers of the market. One would be an undiversified NASDAQ, which is primarily tech stocks. The second, which is the blue section you're seeing on your screen, is a globally diversified 60% equity, 40% fixed income portfolio. We gave that as an example because this is very commonly what some of our retirees are invested in, as an example. But you can see the difference of the max drawdown, not only of the depth of the drawdown of being not diversified in the NASDAQ, but also the length of time it took the NASDAQ to break even. That is that kind of yellowish brown section that you're seeing on your screens right now. So you can see by being diversified, having 60% globally diversified stocks, 40% fixed income, not only was your drawdown not as severe, but you actually broke even much faster. And that has real world implications that we're going to talk about on the next slide.
I would just say this: when things get bad, we feel like, even if we're in the 60-40, we feel like we're on that big roller coaster regardless. And it's hard to keep in context.
It's a good point that Todd brings up, which is even though you can see visually that it's better to be diversified, it doesn't draw down as far, listen, being down 20 or 30% in a correction in the market still doesn't feel good. Both have similar negative feelings, but visually you can see there's a difference in being diversified. But let's take it a step further. What you're looking at here right now is a multi-year time horizon, what's called a rolling 7-year return average. I want to make sure I explain what this graph is showing you so that as we look at the next graph, it'll have meaning. So each of those lines on the graph is representing a quarter going back to 2001 at the far left side all the way out to the year 2020. So it's about a 20-year timeline, but it's a quarter of time. And then it is looking at that quarter and looking back over 7 years to see if the average was positive or negative. If it's above the line, it was a positive 7-year average. If it was below the line, it was a negative 7-year average. The graph you're looking at on your screens right now is the NASDAQ. So this is an undiversified kind of single sector of the overall markets, in this case, tech. What you see in the middle there is that there was a 7-year average that went negative. As a matter of fact, if you really understood how to read this, it actually means that there was about a decade-long time, if you own just the NASDAQ, that you would have not had a positive average rate of return. You would have had a negative average rate of return. Now, if you go to the right of those losses, you can see the next 10 years were spectacular in the NASDAQ. As a matter of fact, we are living through those right now. That is the far right side of your screens. But think about that. Let that sink in. In an undiversified single sector of the markets, namely the NASDAQ, you could have run into a decade-long experience of negative average annual rates of return. I cannot emphasize how painful that would be.
And I would just say, we were talking about this earlier, most of us, even us, financial professionals, we always look at this past year when we check what's happening in the market. How's it done the past year? And what we're showing you here is really for what we try and get people to adhere to. For the person who actually has been in it and been disciplined for 7 years, how are they doing, right? Not just one, but over the course of time, someone who stayed the course. And I think what we're trying to show here is that, going on that roller coaster has some very good times, but it also, you'll have some extraordinarily long periods that are painful as well. And I don't know about you, but it'd be tough for me to look at any statements and say, wait a minute, I've been down for the past 7 years.
Be tough. Now, again, what we're showing you on your screens is the NASDAQ, an undiversified sector of the overall markets. What I now want to show you is if we look at that same example, 7-year rolling averages, but now do it with a 60% globally diversified equity, 40% fixed income. That's what's on your screens right now. Let this sink in. You can now see that for the last 20 years, there would, at least for the last 20 years, this certainly isn't a guarantee, but for the last 20, there was not any time frame that a 7-year rolling average would have been negative.
For the person that can stay the course, stay put.
That's right.
Multiple years, it's a very consistent.
That's right. We have this kind of phrase in our business, which is we want people to stay the course because, as you can see, if you stay the course, you benefit from that. But we want them to have a ride that will allow them to get there, right? And if your ride is too volatile or takes too long to hit your targeted goals, many people will just abandon that ship. And so again, I'll flip back. This was the undiversified NASDAQ where there were times where it was either very low 7-year averages or negative 7-year averages. Compared to a 60-40, it just is significantly different.
And even in the worst of the eye of the storm, remember the drawdown, that for someone who stayed the course, generally they have not been down, if they've been in a diversified portfolio and stuck to it and rebalanced it each year. But for the person that got on the high flying NASDAQ, they did very well, but they went through a long period of pain, during that market downturn. And the drawdown feels just as scary for the person that's all in 5 tech stocks as it does who's in a well-disciplined, diversified portfolio. We always want you to try and keep the right point of view, stay disciplined, and know that time horizon is something that is on your side in so many ways if you invest the right way and thoughtfully.
Well, so if we go back to the statement I began this section with, which is that diversification is about increasing the likelihood of achieving your targeted outcome. I hope that this graph helps you see what it is that we're referencing, that it is about really smoothing out the volatility when you look at it over time periods.
If I might say, a lot of people say, well, gosh, this looks a bit more boring, but
that's a good point.
I had said to CJ earlier that the truth is that successful investing is often like watching the grass grow. It is terribly boring. Yeah. And it is not as exciting as the high flying stocks that are talked about in the news and going up 150% each year and dominating the marketplace. But what gets people to the outcomes they need is slow and steady wins the race, in a sense.
Right. What I want to reiterate as we look at this, it doesn't mean that every client we work with is in a 60-40 portfolio, or that we would even suggest that to them. Certainly when you're younger, you could have upwards of 100% in equities, although we would never, and I do mean never, put a client's portfolio all in the NASDAQ. We would always be globally diversified, even if you were all stock. So we certainly aren't against ratcheting up the overall risk or equity orientation, or even ratcheting it down more from what you see here on the screen. But it's rather about emphasizing the point of diversification. Diversification doesn't guarantee you against a gain or a loss, but it increases substantially the probability of achieving your targeted outcome. It's why we do it. So let's transition, because a question you should all be asking is, well, what does this all mean for you as an individual? So up on your screen is a final slide that we'll talk about before we go to our Q&A. Effectively, our goal is, again, to maximize that success in retirement. And if we think about diversification as a tool of increasing the likelihood of achieving your targeted rate of return, that can very easily be interpreted into also achieving a successful long-term retirement. And surprisingly, success or failure in retirement is actually less driven by the markets and more driven by financial behavior, decision-making, like paying down your debt or about saving enough for retirement. It's more driven by those activities than it is driven by the market. A lot of people will think, I will succeed or fail if I buy the right stock. We would say, no.
Or if markets are better for me than on average.
That's right. We would argue, no, you have more control over that financial outcome than you believe, which is about your financial behaviors. So we would encourage everyone, and it's one of the reasons in the meetings that you run with us, why we focus so much on financial behaviors. We update balance sheets, we look at how you're paying down your debts, we look at how much you're saving, because we know that that ultimately will have a greater impact on your long-term success than whether or not one president gets elected or if the market is going up or down. I realize that this really cuts against the grain of what you're hearing in the media right now. And that's good. That's our intent. We want to give you the facts of what we see have been playing out for the last 45 years of being in business. And I can just tell you flat out, your success financially should not be driven by who's in the White House. You should be able to move towards your retirement goals regardless of that. So we have a tool. One of those is up on the screen. I won't go into detail on this, but it actually does look at best case and worst case scenarios. Because as you can imagine, it doesn't feel good to a retiree when we just say, you're good to go. They might say, well, how did you come to that conclusion? And did you look at a what if scenario if things got really bad? So I just want to let you all know, we actually have incredibly powerful tools that helps us look at the best and the worst case scenario given a set of market outcomes to help you, again, be confident as you move towards your retirement goals. With that being said, let's go ahead and transition into the Q&A. And again, as I mentioned, please be submitting your questions at this point, and we will read them off, and hopefully we can get through them all.
I didn't wear my glasses, so I will read them off and come sit back down after. Let's see how.
Yep, sounds good.
Okay, the first one, CJ, it says, I've heard about high dividend stocks that have a 4 or 5% yield. sounds like a good investment in today's low rate environment. What do you think of high dividend stocks? We'll open it up to you. I can opine as well.
Yeah, so Todd will probably be better qualified to answer this question than I. But to answer that question, dividend paying stocks are all about generating kind of more passive income, dividend paying income, instead of having to sell a security to generate income. And while that sounds great on paper, we would say we care more about total return than we do about just a dividend paying stock. So there's quite a bit of, I'd say, noise in the media and financial news.
I can understand
about
why
this.
they're very appealing in
Right.
the marketing ads, but high dividend stocks can be risky because they might pay a high dividend, but have no ability to keep paying it, or have borrowed significantly with debt to finance the dividend. So certainly one of the things that we like to employ is what we call the dividend growth, which is this idea that you own stocks that don't necessarily have the highest dividend payout yield. They might have a more modest yield, but they have a consistency of growing their dividend payout each year, the sort of pay raise that it gets.
Yeah.
And that's been a good way to invest and we think there's value, right, in getting that income, especially when bond yields are so low. But you have to be careful. The old adage, if it seems too good to be true, it probably is. It is spot on the mark with high dividend yields.
Well, and to finally put the cherry on the top of all of this, we are agnostic, I would say, as it relates to dividend paying stocks. We're not for them or against them, but rather there are more important factors,
Yes.
is what we would say. So I can see with this.
Okay.
Are we in a tech bubble is the next question. Good one. I'll leave that one to you.
So I will say this, we mentioned earlier, the stock market concentration today is certainly unique. It has echoes and shades to 2000 in terms of a small number of companies dominating the marketplace in terms of their size, their performance. But are we in a bubble? Not necessarily. I would just say this: the phenomenon we've experienced with these 5 stocks is not new. It's been happening since 2016. They've beaten the rest of the market, the other 495 stocks, handily, and they are businesses that have been able to grow. Now, should people be willing to pay any price for them? No, but I don't think there's the evidence today that the stock market itself is in this unjustified bubble. There's no doubt that it's part of the reason why we diversify and spread out and invest around the world. I certainly would tell you that I wouldn't want to put all of my money in the S&P 500 today. That doesn't mean I think it's a bubble either.
Right.
That's how I would frame it.
I think you're spot on. We would say reflect back to some of those slides we showed you before, in that sectors of the S&P 500, sectors of the global economy can do really well or really poorly. We don't want to be on the wrong wagon at the wrong time. And so for us, it's actually more about diversification. We're not predicting or not predicting a bubble in the tech stocks, but we're rather just saying you shouldn't be in just tech. You should be globally diversified.
And just making sure that it doesn't get out of kilter over time. That, for instance, I would say this, that 10 years ago, owning that S&P 500 ETF probably was a better way to stay diversified than other things equal than it is today. So we keep an eye on those things. But a bubble that's about to pop, I don't believe so. I could be wrong, but.
Agreed. Yeah. Let's jump ahead here. Next question. How do you see the results of the election either way affecting portfolios?
They're going to put us on the spot. We have to give it
yeah.
Not going to let you guys off the hook without anything.
You go first.
So if I can frame this, what we think we're being asked here is that how might a Republican winner and Democratic winner, who are some of the winners and losers within the stock market in either case? Again, I want to emphasize that the stock market itself in total will not be affected and move one way or the other by a candidate winning from either party. But when you look under at the hood at the subsectors, the industry, there are absolutely winners and losers that stand to gain or benefit from who's in office, who's in Congress. For instance, the energy sector has been battered this year. Low oil prices, it's been a really challenging environment. certainly a Democrat getting back into the White House and rolling back the regulatory agenda that's been in place for the past 4 years, that's a sector that would be adversely impacted from a Biden Democratic presidency. And on the other hand, those awesome gainers of technology stocks, the types of companies that are doing business globally, they're doing business in China, doing acquisitions of TikTok and Chinese companies, those types of companies, certainly would in a Trump Republican scenario back in the White House, they would be relative. I don't want to say it'd be unfair, but certainly that comes to mind as a group that a Republican president, other things equal, is a negative for.
Right. Right. So I will more broadly answer the question. There will certainly be subsectors of the S&P 500 that will be winners or losers depending upon the outcome of the election. But more importantly for us, it's about getting the right exposure for the right client over the right period of time. And we don't get into these sub-asset class investments ourselves. And so we're not overly concerned about who wins. Truth be told, we are more concerned about getting a winner in the election, because I think that's one of our big questions, is if we will have a clear commander in chief after these elections, but time will tell.
So we have a good question here. I'm going to try and interpret it. It's got a couple pieces to it, but it asks, given that the markets are dynamic or static, and we work with two types of clients here, builders and spend downers. And I suppose if I could
accumulators and distributors,
people who are looking to grow and people who are in retirement, and they have two different dilemmas. How would you be investing today for either? I'll take that first, a couple points, and you can add on to that.
Perfect.
There's no question that the challenges today are quite different, whether you're a long-term grower in your goal or you're in retirement and taking that income. And I know we work with a lot of retirees. It is a much more challenging environment for that person in retirement. And I say that in the context that just 15 or 20 years ago, someone that said, you know what, I feel good about where I'm at. I don't need to grow and buy that second or third house I've dreamed of, could sit in bonds. You get a 7% return. I mean, going back to the 90s, and that was a choice they could make for that person that retired. And the challenge today is that you are trying to make sure that you keep up with just your living expenses. And that is very hard to do only being in safe investments. I think what we're looking to figure out where we can get some incremental return in fixed income for the people who are very bond heavy. We're looking for that. There's places where, okay, we can get a little bit more by being in the right places, spreading out into things of fixed income that most people overlook. And on the stock side of things, I would just say, I'm less worried for that investor long term. I mean, call me an optimist, but the truth is, the person that has a lot of time, yes, the market could have another bear market in the future, but I think the person who's got a long time horizon that makes the right decisions, doesn't move their money into all those sharp edges that can really blow them up, has a really good outlook ahead in terms of your portfolio can deliver the same way that it's kind of come to be expected over the past 20 years. It is that bond portfolio, that bond portfolio, that the past will not be like the future.
No doubt. Yeah, I think Todd did a great job of answering that. I'll add on a little additional color. So we often say inside of meetings, and some of you have heard me say this before, that volatility is your friend when you're an accumulator. Okay, so you're saving. And if you think about this, it's called dollar cost averaging. As the market goes up and down, you are purchasing into stocks along that time horizon. So generally, when you're younger, we would suggest, as a general principle, you should have more equities, because that volatility that comes with equities is a good thing when you're accumulating. But volatility becomes a bit of a sharper edge and can become an enemy when you're in the opposite phase, the distributor phase, meaning that you are actually reverse dollar cost averaging money out of your portfolio. So some people will, we would say, errantly focus on just total return of a diversified portfolio over any 10 or 20-year time frame. And so some retirees will come into our office and say, I just want all stock because I know all stock's going to do better. Our question is, are you drawing money out of that portfolio? Because that's when that just a risk at all costs is not the wisest move. So we would say there needs to be a balance that you find, even for those who are comfortable with the volatility of the market. When you are in the decumulation phase, known as the distribution phase, you really have to be sensitive to how much volatility you're taking on. But to emphasize Todd's point, it is at these moments in time that retirees have to pause and say, maybe if they were a 50% stock, 50% bond investor for the last decade, the equivalency of that moving forward might be a 65-35. Yes. So there is something to be considered about actually ratcheting up your equity allocation in these low interest rate environments.
I'd say two things today. I want to go back to our financial planning focus, because I think that is really important. Number one, you're going to have to take risks somewhere. I call it growing pains, right? Yeah. To grow, there's going to be the pains, which is just as we talk about, kind of those risks you feel along the way. But if you can stay the course, take the growing pains, it tends to deliver with a high degree of probability that you're going to have a good outcome, right? And I think looking at the stock market and owning some stocks in that manner is an important thing as people go into retirement. And it will be a rough ride. And it's always sort of, what if there's a 40% stock market decline right the year when I retire? Well, we'll evaluate how that affects your picture. And the other thing to say is, oftentimes, and I say more so for compared to the person that worries about the bear market the year they retire, or the person who's taking income in bonds, that the person who really wants to extract the income and live off their portfolio, that's a tougher thing to solve for today. And there's not necessarily an investment solution that solves that person's challenge when there's a course correction for them. And I think that is important, that there are other things, and your investment portfolio isn't always going to be the lever that can help get you out from some of those challenges. And we try and look at all the angles and tell you what's realistic and be truthful about it.
Absolutely. Yes. Well, let's go to our last question here. What do you consider a minimum value for total assets needed to retire in 10 years?
You can take that one.
I'll take that one. That is a financial planning one. You can go and pull up the disclosures as I'm ending here. Yes. So what is a minimum value? The answer is there is no minimum value, and I'm going to give you a very practical reason of why. We have some clients that we work with who, between Social Security and pensions, have over $150,000 a year of retirement income. And one that I'm thinking of by name right now, although I won't use their name, one of them actually only spends about $100,000 a year. Okay, but they generate about $150,000 between pension and Social Security. So the answer to the question for that person is they need exactly $0 inside of their portfolio in order to meet their overall objectives. Another person who maybe didn't earn as much, might have smaller Social Security benefits, or they're single, they don't have a spouse with Social Security, and they might have children still living with them. The amount they would need in a portfolio could be potentially millions. So actually, I love that question. I truly love the question, because it gets into the heart of, from our perspective, why individualized financial planning matters. It's not just about a portfolio. It's not just about saving for the future. It is about the entirety of the picture of your financial life. Will you have a pension? What will Social Security look like? Will your kids be living with you? So on and so forth.
So unique for each and every one of us.
So unique, but absolutely love that question. So Todd, any final thoughts?
I don't know. Should I just pick a big number or no?
Yeah,
I was
$10 million.
My mother is a teacher and does not have a particularly large retirement portfolio. And I was working with her financial planner years ago, has a similar process as CJ described with some of the tools we use. I was really worried, but my mom moved from California, very expensive state where I grew up, and now lives in Arizona. And so she looked at some of the levers she could pull, and so I don't know what her magic number is, but
there is a magic number for all of us. It's just, unfortunately, you may have to sit with a financial planner to find out what that number is for you. With that being said, listen, this is our second time now doing a Zoom webinar format. We certainly appreciate you all tuning in. As I mentioned, hopefully you're not getting too much Zoom fatigue. We have tried to up the quality of these by having a better
How nice does this
background,
look?
having good lighting, and hopefully you've appreciated that. But let me just end with this. As always, we would not be here if it wasn't for the trust and confidence you've placed in us, and we take that very seriously. And so we just want to say thank you to everybody on the line right now who is a client of ours. We will be doing another one of these another quarter from now, so be on the lookout for an invite for that in another 3 months or so. And then we will also be sending a recording of this out via our website to everybody who both attended or had subscribed to this.
And since you all are probably on a lot of Zooms, if you get any ideas of interesting stuff, of what we can do to make this better, we know you're seeing a lot of good stuff on Zoom these days. Send us some feedback and let us know how we can make this better, more engaging, and useful for you.
Absolutely. Thanks everyone for tuning in, and we will see you again next quarter.